What if I told you that a simple deadline could actually be more powerful than a big cash bonus? Well, today, we're diving into a Nobel-recognized paper that did just that. It cracked a huge policy puzzle. This is a fascinating story about a clever experiment, a bit of human psychology, and a breakthrough that completely reshaped how governments help people get back to work. So let's start with a question that really keeps policymakers up at night. Imagine for a second you're receiving welfare and the government comes along with an offer. A generous but temporary cash bonus for finding a full-time job. Is that incentive really enough to convince you to work? And maybe more importantly, what happens when that bonus eventually runs out? The stakes here, well, they couldn't be higher. The answers to these questions shape policies that affect millions of lives. They determine who joins the workforce, what their financial future looks like, and how governments spend literally billions in taxpayer money. Getting this right is absolutely critical. To get real answers, economists needed more than just theories on a blackboard. They needed a real-world test. And that brings us to this fascinating policy puzzle that popped up from a major experiment in Canada. Okay, so this experiment was called the Self-Sufficiency Project, or SSP for short. It offered a really significant earnings subsidy to people who'd been on welfare for a while. But there were a couple of really important rules. First, you had to work full-time. And second, and this is the part you really got to pay attention to, you had to find that full-time job within 12 months of being offered the deal. If you missed that deadline, the subsidy was gone forever. But if you made it, that bonus was yours for 3 whole years. And here we have the results. This graph, right here, is the entire puzzle we need to solve. The top line shows the people who didn't get the offer. The dotted line, that's the group who did. The gap between them, this curve down at the bottom, shows the program's real-world impact. Now, it clearly worked, but just look at that bizarre shape. The effect grows, it peaks right around the 15-month mark, and then it just starts to fade away. Why? Why that specific curve? That's the mystery. To solve this, we've got to play detective a little bit and look for clues hidden inside the experiment itself. So let's break down what the data can tell us and what it can't. So our first clue is in how the experiment was designed. It was a randomized controlled trial, an RCT, which is pretty much the gold standard in this kind of research. This just means people were randomly assigned to either get the offer or not. And because of that, we can be really confident that the effect we're seeing is real. It's not some statistical accident. The program genuinely caused this change. So the experiment gives us the what, a credible measurement of the impact. But here's the thing. Knowing what happened isn't the same as knowing why it happened. And that leads us to our second clue, which is something we all know intuitively. People don't just react to today's incentives. We think about the future. Our behavior is shaped by anticipating rewards and, maybe even more so, by anticipating deadlines. So the really crucial point here is that the SSP didn't just create one simple incentive. It actually created 2 very different ones. The first one was like a race. We can call it the establishment incentive. You had to sprint to find a job within 12 months to establish your eligibility. The second one was the reward, the entitlement incentive. Once you won that race, you were entitled to that nice subsidy for 3 years. It's pretty clear these 2 different forces were likely driving 2 very different kinds of behaviors. And understanding this distinction is exactly what led David Card and Dean Hyslop to their big, groundbreaking idea. They realized you couldn't solve this puzzle with just the experimental data alone. You needed a way to see the underlying structure of how people were making these decisions. Think about it like this. The experiment gives you a perfect photo of what happened. It's a crisp, accurate snapshot in time. But an economic model, that gives you the blueprint. It shows you the underlying structure, the reasons why everything happened the way it did. So the photo shows you what a house looks like, the blueprint shows you how it was actually built, and it even lets you predict what would happen if you decided to, say, move a wall. This combination, this fusion of ideas, was the core breakthrough. For decades, running experiments and building theoretical models were almost seen as 2 totally separate fields in economics. Card and Hyslop's genius was to snap them together. They used the rock-solid evidence from the photo to build and then test a reliable blueprint of human behavior. So, armed with this powerful new combination of tools, they could finally go back to that strange-looking impact curve and solve the mystery once and for all. And here it is. This is the solution. The model allowed them to break that one mysterious curve into its component parts. So first, look at the line with the squares. This is the establishment effect, the impact of that 12-month race against the clock.
See how it creates this huge initial spike that peaks right around the deadline? That's the power of that time limit, right there in action. But as that deadline effect starts to fade away, a longer-term effect, the simple reward for just staying employed, that one takes over. And when you mathematically add those two separate effects together, you get the solid black line at the bottom, which, you'll notice, perfectly matches the curve from the original experiment. The mystery was solved. That curve wasn't one thing, it was two totally different behaviors layered right on top of each other.
And the model even put a number on it. At the program's peak, a staggering 55% of the total effect was driven purely by that 12-month deadline. I mean, think about that for a second. The race against the clock was actually more powerful than the cash reward itself. The impact of this discovery went way beyond just solving one puzzle. This method, this idea of combining the photo and the blueprint, it created a new gold standard for figuring out what actually works in public policy. So why did this paper really change everything? Well, it took policy experiments way beyond a simple did it work or not, and it gave us a much, much deeper understanding. By integrating the rock-solid credibility of an experiment with the deep explanatory power of an economic model, it proved that the design of an incentive, the timing, the deadlines, can be just as powerful, if not more so, than the actual dollar amount. This whole approach became the new benchmark, influencing how social programs are evaluated all over the world. The ultimate takeaway is really this. To truly understand if a policy works, and even more importantly, why it works, you need both pieces of the puzzle. You need the credible what that comes from a well-designed experiment, and you need the explanatory why from a well-grounded model. One without the other just gives you an incomplete picture. And all of this leaves us with a final, really powerful thought. In this super complex world of human behavior and public policy, it's not just about giving people incentives. It's about understanding that how you structure those incentives, how you time them, and the deadlines you create, well, that can make all the difference in the world.